The broadcast is now starting. All attendees are in listen-only mode.
Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending June 2nd, 2017. So we pretty much wrapped up through May. May turned out to be a much better month than a lot of analysts and folks thought. And we're now going into June, which is traditionally one of the weakest times of the trading year, one of the months that in the summer, you know, the old sell in May and go away kind of thing. But we're seeing some very strong price action here. And basically what I wanted to review in this weekly update was it seems like it's going to be a horse race right now between debt and equity. And I'll show you what I mean in just 1 minute. But what I've got on the screen here is a weekly chart of the S&P 500 E-mini futures. And I've got a lot of drawings on my screen here, but what I wanted to do is just kind of step out real quick and show you a couple of key pivot points. And from there, we can go into a daily chart and then just kind of review where everything stands right now. What I've got on the screen here, as I said, on this weekly chart, there are a couple of key pivots that are very, very important as we go forward in time. One key pivot is that low right there. And then another key pivot is the high right there. And in fact, you can see, and let me just change the color of my pen here just 1 second so I think it'll stand out just a little bit better here. So you can see that bar right there represents an Elliott Wave 5 on a weekly chart going back to 2015 or 2016. Actually, the high that was made in 2016, and it took us quite some time to take that high out. But you can see here that with this bar, we finally took it out in this area here, and then we've continued this regression channel. You can see the upsloping line and the downsloping line here. And then you can see it initiated back here with the lows made in February of 2016, and then a very key pivot high that was made in 2015. And this was the Elliott Wave 5 projection off the pivot high in 2015. And let me just back out just a little bit further so that you can see it a little bit better. In fact, what I think I'll do is I'll take everything off my screen here. And let me just turn my drawing pen or drawing tool off here for just 1 second. And let me just take everything off the screen here so that all you see are the fib nodes. And then if we back out just a little bit here, you'll see here, these are the key pivots that I'm talking about, okay? The pivots basically are this pivot high right here back in 2015 and this pivot low in February of 2016 when we had that really horrendous start, decades worst performance start to 2016, if you remember, in January and February when the markets had a correction of over a 10% drawdown. But using these two key pivot points, and these are the most valid ones going back at least 6 or 7 years, okay? You can see here, and what I had on the screen was this upsloping line right here, this channel. And we're inside this channel, or we're just now going back inside the channel. And what this Elliott Wave 3 created was an Elliott Wave 5 right there. And then we hit that 5, and then we had a little bit of a minor correction, as you normally do with an Elliott Wave 5, and then we've just gone to the moon up like this, okay? So in using that key pivot high and that key pivot low, Fibonacci has projected, and not me, but Fib has projected in what I call dry powder territory, meaning when you're making all-time highs, you got to go, well, hey, what is the resistance point when we've never been at this area before? And the best way to classify these is using fib nodes. And you need to be able, obviously the fib node is only as good or as probabilistic as your accuracy in choosing pivot highs and pivot lows, especially with fib extensions, meaning I'm extending beyond all-time highs to project in dry powder territory, where in the heck are we going to find resistance? And I'm going to show you here on the daily chart where that is. But for now, I just wanted to give you kind of a backdrop of just what I'm looking at in the equity market. Okay, so let me just clean all of this up here for a second and turn off my drawing tool. And as we move out in time, and if you look on here, you can see off on the right-hand side of the screen, a 1.618 extension, right, off the prior pivot high and low, as I showed you, was at 2340. A 200% extension is 2466. So that is going to show, and let's call it 2465, the 2460 to 2470 area, because it's not designed, fib is not designed to be an exact, precise to the penny point, but rather a zone, give or take, a few e-mini points. And Fibonacci, for those of you that aren't aware, measures fear and greed. It measures probabilistic, not 100%, but probabilistic resistance points and support points based on the human condition and the human tendency to chase highs and to get out at profit levels or to buy lows in order to project potential profits when the markets have fallen. So fib has done a very good job of that, and these are just these percentage points that tend to be where human nature is a buy point and a sell point. Okay, so you can look in here, and if you need a lot of detail on the fib, I highly recommend that you go out and just Google Fibonacci, and you'll get some great, wonderful reading. For our members, excuse me, we spend time on Fibonacci just so that you understand how to use it. And again, every individual tool that I put on the chart is not a tool that I use to trigger in and out. It's just one of a few primaries that I use to give me an edge or a probabilistic movement in the markets. So the next level up, as you can see here, is 2466.53. And then at the level above that, 25.92. I've said that we've been in a buy the dip really since January, since this entire year, 2017, and we've been a buy and a dip. Now, I've got friends that are just constant perma bears, meaning they're just waiting. They keep selling these rallies, and they're getting killed, literally killed. Eventually, they're going to be right, kind of like a stop clock. Every day, it's usually going to be right twice a day, right? But outside of that, they're just, you've got to follow price action. You've got to let price action dictate. So we're not trend predictors, but we're trend followers. And we use a combination of tools in our group and our membership on how we do this. And for those of you that have been following this free weekly update for years, probably have already come to the conclusion that we're generally we're very good at calling where the market is projected to go. We've got that edge. And I won't profess to say that we're at 70 or 80%, but we got enough edge here that we make good money with what we do. So let me zoom in now on a daily chart. And you can see on this daily chart where we had this fib node here at roughly about 2340. And you can see this volume over price on the left-hand side of the screen here, right? So if you look at volume over price, basically what that says is what is the buying volume or the selling volume at each of these levels. And you can see at that level right there, there is a lot of buying versus selling, or buyers versus sellers. You can see this really massive amount right there of buyers versus sellers. And right now, the buyers have been stepping up to the table and have been, taking charge. And you can see that at these levels, you've gotten, and I don't show it here on this fib node, but this fib node happens to be almost right at about a 1.5% extension, 1.5 extension off those prior pivot highs and lows, okay? Almost right in that area to the T. And then you can see all of this buying versus selling right here is sitting right on, slightly above the 2340 area. So now the next level up is 2466. You can see on this daily chart, I've got a 3, 4, 5 leg following. Now it goes without saying that the 5 leg, this Elliott wave 5, traditionally, the duration of the Elliott wave 5 right here, let me just clean it up again because I tend to act like John Madden on some of this stuff and I just draw and draw and draw. So traditionally, the Elliott wave 5, which goes from the 4 to the 5, is a lot less significant than the Elliott wave 3. The Elliott wave 3 is kind of the impulse move. That's the bigger move. And then you got a final, the area where a lot of rat brain traders come in is they tend to chase it towards the high. They give up and boom, they come in. Meanwhile, big institutional players are starting to hedge off their risk, upside risk. They're taking more and more debt versus equity as far as where they're parking some of their cash. And I'll show you more about debt here in just a minute. But we're clearly at all-time highs on the E-minis. And the projection on Fib is saying 2466. And I've, to me, once we came above the 2400 level and we broke out of the Elliott wave 3, I said, okay, we're off to the races here. And it's going to have that run up, which is what we did. And we've been in a buy the dip mode every week, going all the way back to March. I've been saying I'm expecting a dip, but we're a buy the dip kind of mode. And that's kind of where we are right now. Now, with an Elliott wave 5, typically what happens on an Elliott wave 5 is there are a couple of patterns that we can expect, okay? These patterns basically are either from here. Now, it's saying the Elliott wave 5, let me just move this back up because I accidentally grabbed the wrong line here, right? So let me just move that back up. So it's right up about, let's get it down, right about there, roughly, give or take a couple of points. So the Elliott wave 5, typically the conclusion of an Elliott wave 5, which is what I'm sure a lot of you want to know, is the 3, 4, and the 5. It can run up a little bit higher, right? Now, the Fibonacci is saying right around 2466, 2467 area, okay? But then after an Elliott wave 5, you have what's typically a chop, an ABC pattern like this, or 1, 2, 3, or however you want to call it. And then A is going to mark another interim pivot point, B will mark a pivot point, and then C will mark a pivot point. And by the way, all of this work, to get this a little bit more accurate, we're using a daily chart. These patterns appear on 1-minute charts, 5-minute, any interval, tick charts, but use daily to give you really the overarching pivot point levels, okay? Now, what I want to do and what I'm going to be looking at is inevitably we will get our ABC after the 5 leg has finished its print, okay? And once the 5 leg has finished its print, then we get this A leg. And then I'm going to look at that pivot point. And then we get a B leg. And then I'm going to look at that pivot point. And then the C leg. And then I'm going to look at that pivot point, right? Where is it? If the C is lower than the A and the B is lower than the 5 leg, which would be right up here, the all-time highs, then that means we could start to form one of these kind of channels, which again, we would be the buy the dip. That was exactly what happened with that channel right there, okay? And a buy the dip means we stay in this dip mode until it looks like we get a trigger to buy going back in. And this trigger right here just happened to be over in France when Macron won victory over Le Pen, and then there was kind of an all clear signal. And it looked like the market's going to extend higher and give us this Elliott wave 5. So this is an ABC pattern that gives us this dip mode typically. Now, the other alternative for that pattern is going to be something similar where we've got an ABC again. But in this particular case, it is more of, and if you connect the dots, it's more of a sideways pattern going like that. So now we've got this here. And then obviously the other one is where the B leg makes a higher it makes new all-time highs, and then the C leg makes a higher high than A. So then you get a little bit of a channel like that, which is just a continued grind. Okay, so there's three possibilities, and don't let anybody tell you that the markets are going lower or they're going higher or they're going sideways until the markets decide to tell you what it wants to do. I think anybody that tries to predict this stuff is really insane, or they're just trying to sell a book or something. What I'm telling you is, and what has made us very successful, is that we identify the key levels and then we assign probabilities to them, 55, 65% probabilities. And we have certain patterns that generally are over 60, 65% probability edge. And it's not to say that you could wake up one morning and then you see the market's just doing something entirely different because you've gotten some unknown news event, hitting the news line or the wire tape, and it's causing the markets to react appropriately. So those are always the unknowns. And we got a lot of unknowns out there. They're all known to us at this point in time, but they're unknown as to if or when they will trigger. Some of them can be devastating to the market, like any kind of fisticuffs, bombing, shooting event with North Koreans. Others can be pretty severe on price action, but it won't be as devastating as a war with a nuclear-armed North Korea. That would be like Chinese debt, which is just run amok, or any issues over in Europe, or we get some existential event somewhere in the world which could cause this to happen. So this is what I'm looking at here. Now, of course, when I put all of my indicators back on the screen here, each indicator basically has a story. Each indicator has a reason to exist on my chart. Okay, so if I come back onto the screen and put them all on here, you can see the indicators, and we're near all-time highs here with the equity market. Now, as I said, it's equity versus debt. It is literally a horse race. And if we come in here and we look at debt, and I define debt as the bonds, the 30-year, which is the long end of the yield curve. Bonds finished Friday up over a full handle in 13 ticks. Now look at bonds. You can see here in the bond market, right? You can see in the bond market here, we're near 2017 highs. We're at all-time highs in the equities. In the bond market, we're not at all-time highs, but we're clearly at 2017 highs, right? You can see where we opened the year in the bond market at 150.07. We're now, we closed on Friday at 154.30, 155.16 are the highs for the year. So clearly money is going into debt. And you may scratch your head and say, well, gee, generally you have a winner between debt and equity. Debt is considered a risk-off asset. Money does not want to chase risk. It wants to take a little bit more of a conservative approach and sit on the sidelines a little bit, so money goes into debt. What that does is tends to push interest rates lower. And even though the Feds have come out and the markets have all but priced in a rate hike on June 14th coming up in a couple of weeks with the Feds and Aunt B, aka Janet Yellen, and ECB is meeting next week. They're doing just the opposite. They're starting, or we've been adding or taking money off stimulus out of the markets, and the ECB is full throttle on. Now, there's going to be challenges with Super Mario Draghi, when they meet. They're going to meet actually before the Feds next week. And they're looking at, and he's actually changing the language of their policy statement to say something to the effect of, we're now going to watch inflation very carefully. So that's what's given a boost to the euro. But look at bonds. This drives interest rates lower. In fact, if we were to look at the 30-year interest rate, if we look at the 30-year interest rate, we're going down. So you may go, why are interest rates going down when the Feds are talking about hiking rates? Why is the US dollar going down when they're talking about higher interest rates? In fact, it's already priced into the market, at least through June. over 85% chance of a rate hike, another 25 basis points. The market's going to be watching to see what Yellen's going to say. And I'm going to be listening too, because it's going to determine where the dollar goes, where interest rates go, where gold is going to go, and in turn, where equities are going to end up. Sometimes equities are being, you would think the markets are driven by equities in the technology sector, and there's only 4 or 5 stocks in technology, as I said earlier, that are driving about almost 60% of the gains of the S&P right now, right? I had talked about that in my last session, and that hadn't changed. It has not changed since then. We've got right now Apple, Facebook, Amazon, Microsoft, Google. Their counts for almost 60% of the gains in the S&P year to date. Limited breadth. So, but all of these aren't, you're seeing the other assets that are the risk-off assets, which is where money seems to be going. So that is a big yellow cautionary flag in my mind. And because we're nearing the Elliott Wave 5 or at an Elliott Wave 5 print, which is traditionally the end of the near-term trend in the equity market, then caution is in the watchword. That does not mean that momentum can't take us up to that 2365, 2368 area. But we've already got that Elliott Wave 5 print because we made higher highs from the previous all-time high. So be very cautious. I'm still in a bullish mode. There are some things that we're playing bullish. Most of them, however, are in Europe. If we look over at the currencies, and let me just show you the euro here, or let's line up the dollar just to show you the weakness in the dollar. Look at the dollar, guys. It is down below the 2016 open price. I left that out there. And you can see here on the dollar, lower lows, lower highs. And there are no divergences in here that would be a bullish in nature. And you may be scratching your head. I know some people are going, well, wait a minute, the Feds were talking about hiking the rate, so why is the dollar going lower? The dollar's going lower because there's no inflation. And with there's low inflation, that means the Feds are going to be put into a corner. And it's very difficult for the Feds to argue raising rates when we are, the inflation is not an issue right now. I still believe they're going to raise the rates this June, and then probably again, maybe 2 more times this year, which would be 4 times. The market's priced in 2 more rate hikes, one now and one roughly in September. But I believe there's going to be probably another one after that. But right now, the dollar is just saying, low inflation, even though they're going to hike the rates, we don't see it. And keep in mind, the other thing I keep pointing out about the dollar, it's not really the currency, the dollar. It's really a dollar index based on 6 other currencies, of which the euro is almost 60% of the value of the dollar index. And if we look at the euro, that's been going to the moon, right? Now, this is the interesting dichotomy here. It made 2017 highs on Friday. Lower or higher lows, higher highs. The euro has just gone through the roof. You can see the 2017 open price in the euro is down around $1.05. Now it's at almost $1.13. You remember, if you guys remember a few 3 weeks ago, I'd call the euro at hitting 113. And it could even move higher than that. Because again, a lot of this is in anticipation of Draghi coming out and saying, okay, now we're going to change the nature of our language. So the euro has been very strong. Europe has been very strong. I've got our members playing the European markets, more so than the U.S. equity markets. So this is kind of where we're sitting right now in looking at this. It's going to be a horse race. It's going to be really interesting to see who wins out. If debt wins, that means we're at the peak of the Elliott Wave 5 on the equities, and we can expect a dip in the markets. Again, a dip, not a correction. A correction is greater than 10%. The other thing that I'm looking at is gold. Now, gold, I had originally forecasted gold coming down to around the 1200 area, down in this area here. But on this, you can see here that it's moving back up towards the 2017 high. I mean, gold had a strong day on Friday. You can see here that we had this bull flag on gold, right? And it broke right in this area here. So you can see here was this big move up. Then we had this bull flag like that, and then off we broke. That was a breakout. We did the retest, and now we're coming up here. I believe gold, and because this is an Elliott wave 3, remember Elliott wave 3s tend to be the bigger waves, so it could stop wherever it wants to stop. And then it's going to present a 4 and then a 5, and then we peak out before we go into a sideways consolidation mode. So this is kind of what I'm looking at right here in this market. In the gold market, I think, and you remember me saying, and I've said this all year, gold is going to finish a lot higher than where we started. Now that may sound like, well, gee, that's common sense, right? But it wasn't, because if you look at where gold was and where it started 2017, right? And let's just look at this right here. You can see gold made a 2016 high of 1376, and then it just started working its way down, making a series of lower lows and lower highs. And then coming down here in the bottom down in December, as we opened 2017, I said gold is going to finish higher this year than where it is. I think gold is going to run up. And that's what we've been doing all year. Now, granted, it's been very choppy, but we're making a series of higher lows, which is just one of the things that is longer term bullish for the gold market. Okay, you can see a low here. Well, we started with this low here in December, a low and a low and a low, and the trajectory is like that. So it's, even though we're going up, the width of this, right? The width of this channel is very wide, so it tends to produce and give the effect of a lot of chop and a lot of sideways action. But if you step it out a little bit, we're still going up. And a lot of this is due to very low inflation, but low interest rates. I believe when the Fed start hiking and inflation starts to come back into the game again, you're going to see gold move even higher. Because gold is one of two things. It's either a fear gauge, or it's another asset money goes in to protect against an inflationary environment. So should inflation really kick in, it's going to overcome higher interest rate challenge, because gold hates higher interest rates. But because we got no inflation, you can see right there for 2017, we're moving back up. So really the next clear the clear area is going to be, can we take out the highs of 2017, which is around 1300. I believe we will. I believe it's going to be very choppy, however. So it's really it's a great day traders market, or a swing traders market in gold. So that's kind of where my view is on gold right now. Bullish, a little bit choppy, subject to some downdrafts, but bullish. Oil, we've made 6 trades in oil. Every one have been successful this year. You can see oil is making a series of lower lows and lower highs on this daily chart. And this high back here goes down to a 2017 high that was really made right on the first day of the new year, January 3rd, first tradable day in the new year, January 3rd, 2017. It was our high. And it was also our open. We opened and then we moved up, and then we just sold off, and it's just been going down from there. And this is where we're sitting here, and we've been playing this every week in the futures market with options on oil futures, and we've been successful. So we've just been playing a near-term basis and taking money every week out of the market. So I don't see why that should not continue. As far as near-term direction for oil, you can see it's extremely choppy. Now OPEC, as much as they're trying, they're having a difficult time maintaining order with all of these knuckleheads over there. So I think oil has still got a lot of downward pressure. There's going to be some underneath support here, but we're going to continue our move with oil, right? So momentum may carry a little bit lower, but I think it's going to start to find some consolidation around these levels. So that's pretty much where we're sitting here. If you're not a member of our group, I highly encourage you to come in. We're having a great year. And I think next year, or the remaining part of this year, is going to offer some surprises. And I think it's going to have some challenges, but I think it's going to be another good year for us. So everybody have a great weekend. If you have any questions, just come to my website and send a contact us. I'll be happy to chat with you. Otherwise, I will see you members Sunday night for our weekly market watch. For everybody else, tune in for our next weekly roundup next weekend. Take care, everybody, and enjoy the upcoming week. Ciao, folks.